Hello everyone, hope you all are doing well. This week we will learn about revenue recognition. Revenue is one of the most important performance measure for any company, and several other performance measures such as EBITDA, net income, earning per share, or different performance ratios basically depend on the amount of revenues that a firm generates. In this chapter, we will learn the FASB's latest revenue recognition codifications and the applications of those revenue recognition process. First, we will focus on the five-step process for revenue recognition, and for each step we will see different examples and applications. Then we will figure out some complicated revenue recognition issues applying those five-step process and the recording process, especially the journal entries for all these scenarios, and how those entries and scenarios would affect a company's financial statement. All businesses are not the same. Some businesses might have different type of natures, transaction process, so the revenue recognition may not be straightforward for every businesses. So in past, there were several issues and problems when firms would record all those revenues, and especially distorting the numbers and manipulating the revenue numbers. Those were huge problems, and that's why in 2014, FASB issued a standard on revenue recognition, which is known as revenue from contracts with customers, and this is widely known as FASB's ASC topic 606. And from 2019, and all firms are now using these revenue recognition standards. These revenue recognition standards developed in 2014 and started implementation in 2018 for public companies and 19 for even private companies actually helps to remove several inconsistencies and weaknesses of the previous approaches. So this revenue recognition standard is basically based on asset liability approach. You will remember the term asset liabilities. That means the asset liabilities approach states that you have to recognize and measure the revenues based on the changes in your assets and liabilities. And you all know that we recognize revenues when we transfer any goods and services to the customer in exchange of the amount that we expect to receive. And we must have to recognize revenues in the accounting period when the performance obligation is satisfied. We will also learn what we mean by performance obligations. That means when you receive money from the customer or expect to receive the money soon, you are obligated to provide some performance that could be in terms of goods or services, and you have to record the revenues when you complete those performance obligations. So first, in this chapter, we will learn this five-step revenue recognition process. Step number 1, identify the contract. You have to identify a valid contract with your customers. Then identify performance obligations. Some contract might have only one obligation, some contract might have multiple obligations. So you have to look at those obligations and you have to check whether those are interdependent or separate. Then you have to determine the price, or what we call the transaction price. And if you have a multiple obligations in a contract, you have to allocate the transaction price to separate obligations. And then you have to fulfill all obligations and record the revenues. So these are the 5 steps we will learn throughout the chapters. I'm repeating. First, the contract. Second, performance obligations, whether one or more. Third, transaction price. Fourth, split or allocate transaction price to the performance obligations. And these might be crucial if you have more than one obligations. And then when you fulfill your performance obligations, you record your revenues. Now we will see the 5-step process using a simple examples, and for each step you will see the example will be a little more complicated, and we will see how we can apply those steps. Step number 1, you have to identify the contract. The contract is between the customer and the business. So let's take an example. Tyler goes to a coffee shop named Bean, just like Starbucks or Dunkin' Donuts, and one morning Tyler enters into the coffee shop and orders for a large cup of black coffee for $3. So when Tyler enters into the coffee shop, Tyler knows that the black coffee costs $3, and when Tyler orders that black coffee, it means that he agrees to pay $3, and on the other side, the coffee shop also agrees to make a large coffee and serve it to the customer in exchange of $3. So that means when the order is placed, a contract is established. Now remember, a contract could be written, a contract could be verbal, and no matter it's a written or verbal contract, there might be several items in it, and those could be written or specifically mentioned or could be implied. Right, in this case, just ordering the coffee means it's also implied that the cost is $3 and that will be exchanged between the customer and the coffee shop. Now, when it comes to the question of revenue recognition, we will check whether there is a valid contract. And for a valid contract, you have few other conditions. First, the contract has commercial substance. Some business is happening between the customer and the company. And both parties approve the contract, right? It's impliedly mentioned that Tyler and the coffee shop, they agrees for the large coffee for $3. Identification of the rights of each party. So Tyler now has the right to get a large coffee, and the coffee shop, has the right to receive $3 from Tyler. Payment terms are identified. It's also implied that Tyler agrees to pay $3 for the large coffee. And it's probable that the consideration will be collected. Tyler could pay up front, or right after receiving the coffee, Tyler could pay $3. So these are the 5 items that should be in a valid contract. This is a very simple example, and we see all items are here, so it's a valid contract. So step 1 is fulfilled, and we see that Tyler will receive the large coffee in exchange for $3. Now let's see step 2, similar type of example. Now the other day, Tyler is going to the coffee shop to buy a large cup of coffee for $3, but at the same time, Tyler wants to purchase 2 bagels for $5. Now let's think of the step 2. Step 2 is about performance obligations, and you have to check whether there is 1 obligation or 2 obligations. Now if you see here, from the coffee shop's perspectives, they have now 2 obligations. One is to give a large cup of coffee, another is to give bagels. Right. And then if you think of the amount of revenues they should record, it's all together total 5 plus 3 is 8. Right, so that means when you see the performance obligation or step 2, first check whether there is 1 obligation or more than one obligations. Then you have to think of it whether those obligations are separate or independent, or those are dependent or interrelated. Here in this case, we will see there are 2 separate products, 2 specific prices. One is coffee, another is bagel. And Tyler could just go for the coffee, or Tyler could just go for the bagels. That means those two products or obligations are not highly dependent or interrelated. Right. So you will see in a different or more complicated examples that we need to identify the performance obligations very carefully, and you have to remember or figure it out whether those are independent or dependent or interrelated with each other. So now here these we can say here we have two separate performance obligations. Right. Now let's see step 3. Step 3 is determining the price. So we will see the same setting but a little bit different examples here. The coffee shop also sells some coffee beans. And now another day when Tyler enters into the coffee shop, they say that the coffee bean that they usually sell is for $10, but on Tuesdays they cut the price by $1. And Tyler went to the shop on Tuesday, and Tyler decided to purchase one large coffee bean bag for $9. Now the question is to determine the transaction price. How much revenue the coffee shop or bean should recognize for this transaction, whether the regular price $10 or $9 that they agrees on Tuesdays, right? So here remember the transaction price will be $9, not $10. Because the transaction price is the amount that the company expects to receive from the customer in exchange of transferring the goods or services. Right, the transaction price is easily determinable, and usually customer agrees to pay it right away or within a short period of time. So here the transaction price will be $9 because both parties agrees on selling the large bean for $9 on Tuesdays. Well, there might be sometimes some other options, right, like coupons or other discounts. We'll see those scenarios and examples later. Now let's see step 4. So step 4 is allocating the transaction price to separate performance obligations. The same example, Tyler and the bean coffee shop. But the allocation might be a little bit difficult when you have more than one performance obligation. And when you have more than one performance obligations, you have to remember whether those obligations are independent or interdependent. Now let's see this example. Bean wants to provide more incentives to its customers and offers $2 discount for a large coffee when a customer buys a premium motor mocha bean bag, which is usually sold for $12. Now Tyler went to the shop the other day, and Tyler bought this large motor mocha beans bag for $12, and at the same time he's ordering a large coffee which is usually $3, but they said that if you buy this bean bag you will get $2 discount for those large coffee. That means now Tyler needs to pay only $1 for the large coffee. Now look here, there are two separate performance obligations. Tyler is purchasing two separate products. One is the large coffee bean bag, another is cup of coffee. And then you will see that those are purchased combinedly, but they are not apparently interdependent. But if you look at the price, in total, Tyler will pay $13. Now, in this step, we will allocate the transaction price to the performance obligations, which means how much price we will assign to each product. Should we say that the coffee bag costs $12 and the cup of coffee is $1 because altogether the store will receive $13? Or should we say that the coffee cup is $3 and the rest will go for the bean bag? How we will record that? So FASB's codification actually explained this, and they say that we have to allocate proportionately. Right, when we combined it in one contract. That means first we will look at the standalone selling price for the two products, which you see the motor bean bags $12 and large coffee is $3, total $15. And then we'll see the percentage or proportion of those two products or items. That means the total independent standalone price is $15 and bean bags is 80%, 12 divided by 15, and large coffee, which is $3, means 20%. So if you look at those independent combined price, then 80% should be for the coffee bean bags and 20% should be for the large cup of coffee. Now we will allocate the total transaction price in this scenario, which is $13 that both parties agrees upon. So we will split this $13 based on these 80-20 percentage ratios. That means if we split 80% of $13 to motor bean bags, it will be $10.40, and then take 20% of this entire transaction price and allocate it 20% to large coffee cup, that will be $2.60. So this is how we are allocating the transaction price when you have multiple performance obligations. It's proportionately based on the percentage of the combined standalone price. Now the last step, when we will record the revenues, when the performance obligation is fulfilled. So you see several examples and we see the application of different steps. So when the coffee shop offers the large coffee, performance obligation is fulfilled. Or when Tyler purchased the coffee bean bags and large coffee, or with 2 bagels, when the coffee shop, remember, transfers the goods or services to the customers, performance obligations are fulfilled and they can record the revenues at that point. So remember, they have to transfer the goods and services, and you need to make sure that the customer now has the control over the product or services. So when Tyler receives the bagels and coffee or coffee bean bags, now Tyler has the control over those products. Now the company can record those revenues. So we just saw the 5-step process with a very simple example. So in this chapter later, we'll see more complicated examples and how we can apply those 5-step process.